I want to talk about silver and what I figured out because at first, like a lot of people, when I saw the price of silver go up and I knew about the demand for it, it seemed like a sure deal. And now, from the earlier all-time high at about $121 earlier this year, it is now priced in the mid 50s, which is completely insane. So this got me into this rabbit hole of research, like how did this happen? Okay. Because it's one thing, I mean, from time to time, what happens is that um, banks will actually, or not only banks, but financial institutions will manipulate the price of stocks and that kind of thing. So if you know anything about GameStop, you'll know what I mean. But basically, if the price of a stock goes up very high, all of a sudden, then these financial institutions don't want that because they're actually selling these things called options, which is basically bets or insurance, if you will, if based on whether it'll go up or down. So if it goes up, then you could buy what's called a call, and then that entitles you to buy these shares at a much lower price. Okay, so the guy selling you the call has to all of a sudden give you the difference. Okay, if you buy a put, then what that means is that you have the right to sell somebody a stock at a certain price. Okay, so the stock, if your put entitles you to buy, sell a stock at $100 and the current price is now $50, then you're making $50 profit easily because you just buy that stock, then you force somebody to buy that stock at a much lower price and you keep the difference, right? So that's how in general options work. Okay, so in general, if you're selling those, you do not want the stock to go up too much or to fall down too quickly. That's really what you want to do. And so these institutions are not just thinking about today, this week, this month, or even 1 year at a time. They're thinking about these things at the level of decades. So they don't want it to go up too quickly, certainly not in the span of 6 months. So they're looking at this from year to year to year. And that's really key to understanding this. Okay. So that's stock options. Let's talk about something else here that we need to talk about in order to understand why there's actually two different prices of silver. Okay. So why are there two prices of silver here in reality? There's actually two disconnected worlds. Okay, now silver is silver, that's true. But let me put it this way. If you have some silver bars in your, I don't know, in your garage, right? Some people collect silver, some people collect gold, that kind of thing. Okay. You can even do this with copper, right? Are you going to go ahead and sell it to a factory directly? No, you can't do that, right? Who's going to buy it? Maybe the pawn shop, maybe the coin shop, right? But you personally cannot go and sell it to the factory who's going to use that copper or that silver or that gold because those are used in pipes, electronics, and in batteries. Okay, so basically, my point is that there's two types of silver prices. One is for industrial consumption, right? These guys like Samsung, these guys like solar panel manufacturers, they will take that silver and incorporate that into their products, chips, solar panel. Then that's different, even though the basic silver is the same, that's different from the collector's market. Guys who use that as what's called bullion, right? Guys who own coins, all right? Guys who own bars, okay? guys who are going to use that, to sell much later on in life as a collectible. I want to point to even a third kind of market, which isn't actually silver itself. And that's what's called paper silver, right? So paper silver is something that is really interesting here because paper silver is theoretically a right. It's like a receipt or a certification that is supposed to correlate or connect to what's now called physical silver. So what is paper silver? Is it real? No, it's not, right? It's like a certification. Okay. Think about this as buying a stock in a company. Do you have in your own hands literally a physical piece of the company? No, you have a right to some kind of, um, in a sense, abstraction of that company. Okay, so that is its own kind of thing. So now you've got actually three different uses of silver, right? One is as a collectible, the one is for manufacturing products, and the third one isn't really silver, but it's a piece of paper um, that entitles you theoretically to either silver itself or something that is tracking the worth of silver. So this whole thing gets very complicated really quickly. But this is actually the thing that results in two different prices of silver. Okay. So the prices of silver, one is the one that's actually being contracted about, right? So if you, again, are a manufacturer, that's the price of silver that you're buying it. And it has nothing to do with something called COMEX. Okay. COMEX, and it's not just COMEX, I'm just using that as a stand-in for these exchanges, right? Where you can buy silver or a right to silver. Okay. And that's COMEX. So COMEX is where really what's called paper silver is being exchanged. Okay, so I'm going to take a break here and ask you, Henry, are you following this so far? Or is this just really confusing to you?
It does make sense, yeah.
Okay, because it's going to get a lot worse after this. So if you don't really quite understand it, you want to really try to understand that, right? There's different uses of silver, and they all will end up having their own price because you cannot really easily convert it to each other, right? If you have a bunch of silver bars in your garage, okay, in a safe, you can't just go over there and sell them directly to the guys making solar panels out of it, right? So that's just going to be kind of there. You might be able to sell it to pawn shop, right? If you have these certifications for silver, you can't sell those directly to the manufacturers either. Okay. So in effect, they have their own supply and demand. Well, what makes up a price? Supply and demand, right? Okay. So now is it very clear how there are different prices for this now? All right. So where is the price for manufacturers buying silver? That has got to be very high. That might be something like $80 per ounce. That might be even higher than that. We don't really know because these companies do not tell everybody their contracts. That's not public information. Okay. Now they do come up with these earning reports from time to time, but even with those earning reports, they might not actually tell you what they're being sold at. It's somewhat discretionary. In fact, when they buy these silver from the silver miners or these silver smelters, part of the agreement might be you don't tell other people what what you're buying, what price you're buying these are. Furthermore, they're locked in advance because it's not like, oh, today we're a factory where today we need, you know, 400 ounces of silver. That's not how it works, right? That's unreliable. So what do? They contract in advance, well in advance, right? So they might say, for the rest of this year, we want to buy silver from you guys, 10,000 ounces for this year at $80 an ounce. Okay. And we'll have it delivered every month into this warehouse, etc. Right? That's business. That's stable. It's not going to follow that COMEX, which changes literally every minute. You can't do business that way, of course, right? So they're going to have their own price for that. But that, right, that means that these miners that are selling the silver, they could be selling at whatever price that they locked into it. So they could be extremely profitable. But here's the thing, I knew that and I saw how the prices were being manipulated on COMEX. And I thought, okay, I don't want to buy paper silver because uh, you could buy into these stocks that track the price of COMEX, right? Like for example, SLV, SIVR, PSLV even. Okay. So if the price on COMEX goes up or down, then the price for SLV, PSLV, SIVR, these ETFs or ETNs, they will also go up and down. They won't track the price of silver actually being sold to manufacturers. So if you're an investor or more realistically a speculator, what do you want to do, right? You know that silver is getting harder and harder to get, therefore the price must be going up. So what do? You go over to, uh, excuse me, let me start over here. I lost my train of thought here a bit. Um, so the silver here, let's take a couple steps back here, okay? Because one of the things that I should mention here, and this is a really important thing to take note of, is that the price of silver necessarily needs to go up. Why? Because of something called structural deficit. That's a fancy way of saying um, there is not enough silver being dug out of the ground to satisfy the current demand. There's not enough silver being dug out of the ground to satisfy current demand. Okay. So, what exactly is that? Okay. So I know off the top of my head that the differential is about 5%, right? That there's 5% more demand than there is supply, period. Okay. Um, let's go actually take a look at this, right? What is actually the raw differences of ounces and demands here? Uh, you want to put this on pause for a second? So these are rough numbers that I just pulled out, and they're not going to be necessarily accurate. But the total supply of silver for 2026 is approximately a billion ounces. So, that's 1,000 ounces. And the total demand is 400, excuse me, is about 45 million ounces more than there is silver available. All right. Now, this is the sixth year of this so-called structural deficit. Okay. So what is the case here? Demand is outpacing supply. Therefore, the price needs to go up. That's basically an iron law of economics. So that's really strange, right? It tells us, therefore, that the prices of silver must be going up if you are trying to buy it to use it up. Because once you put it into those products, you don't get it back. I mean, you could recycle it, but you're not going to see that silver for a long time because those solar panels or those chips are going to be used for a while. And it's very expensive to take that little bit of silver out of those chips, out of those solar panels to reuse it. Very expensive, right? Moreover, as we all know, the demand for these things is growing. Solar panels are growing. I mean, you had this Iranian war, and then now all these countries, particularly China, who want to invest in solar panel production anyway, they realize even more and more that getting oil is not reliable anymore. So they're looking at things like solar panels. Okay. Electric car vehicles becoming more and more popular. Their batteries need to use silver. You have something called substitution, where they are thrifting and substitution. Okay, these are kind of ways to explain away why the demand isn't growing as much as it should be. But the problem with this is that there's a couple of problems with this explanation. One, um, even if you're using copper as a substitute, as you know, by having some background in chemistry, Henry, can you actually just simply swap off Cu for Ag?
Not by not without affecting the electrical conductivity.
Right, right. You can't just substitute. You can't be like, oh, this is a metal and this is a cheaper metal. I'm just going to swap it out. No, it doesn't work that way. Copper is not as conductive. Copper is more corrosive, is more easily corroded. It's got lots of problems. Now, there are some engineering attempts that you could do, like put a shell of silver over it or some kind of hybrid paste, but they always end up introducing some kind of inefficiency or vulnerability to the technology. You can't avoid that. So really what you end up having is some solar panels that might be for um, some kind of industrial use. For example, um, you might have these sort of solar panels for your calculator or something, your cheap little calculator. Now, since it's cheap, nobody really cares. After a while, the solar panels on that doesn't really work. Okay, so you might construct some solar panels for that purpose with copper, but you're not, if you're going to try to replace your, consumption of oil, you're going to need something a lot more efficient and reliable than copper substitution. Number two, and let's take a pause here real quick. All right, so we have these sorts of patterns that we find, like Jevon's paradox, or even, yeah, basically Jevon's paradox is this kind of thing that is really interesting. So, particularly with something like energy. So this is where something becomes cheaper over time, and then you would think that people would, um, save the savings that they have. In other words, let me give you an example. Um, let's say that light bulbs become cheaper over time. So you might think that people go, "Oh, that's great. Light bulbs are cheaper. Now I get to save money." Instead, what happens is that actually, ironically or paradoxically, they actually buy more light bulbs. All right. And that's actually a reason why, you know, I think even if you're young, you know who this is, but, um, somebody who was called the Unabomber, Ted Kaczynski, he wrote about this in this manifesto of his, where he was talking about how the energy consumption will always grow. No matter how much energy is produced, it will only encourage more energy consumption. And that's Jevon's paradox, that what you actually end up having is not people saving the savings, you know, once things become cheaper, they actually buy more. They actually buy more. Okay. As long as there's underlying demand. Okay. So there's always underlying demand for energy. So they will always want to buy more. Okay. They will always want to buy more of what they had. Okay. Um, so if you're thinking about how that would affect the theory of thrifting, okay, resulting in less silver being consumed, it makes no sense, right? Because if you can make solar panels with less silver, do you make more solar panels or less solar panels, right? What do you do, Henry?
You would probably make more solar panels then.
Right. As long as people want to buy solar panels, just produce more solar panels. So do you consume less silver? No. And because you consume less silver, the demand of silver is still high, and they're not producing more silver, right? There's approximately a 5% deficit, and so the price needs to increase. At the very least, the price should stay the same. It shouldn't drop all the way down to less than half of what it was earlier that year. That makes no sense. Okay. So we talked about right now the supply and demand situation of silver and why we know that the price of silver needs to go up by the very most fundamental law of economics. But here's the thing about COMEX. COMEX, it has silver. It has physical silver in their vaults, and there's two types. There's registered and eligible. Eligible does not actually mean eligible to be sold. Registered does not mean they're keeping it. So this is something about the financial industry is that they always use these terms that make no sense. Okay? They don't make no intuitive sense, and it's done on purpose because they are trying to mess with your ability to grasp what's really going on. The more confusing terms you could use for what's going on, the more they can convince you this is not actually gambling. And the more they can get away with manipulation. All right. So that's why they say stuff like calls and puts, and it's all very confusing, you know? It's all very dishonest. There's no genuine here, right? There's no rectification of names here. Okay. So they're always manipulating these terms in order to get away with this or that. Anyways, we have two types of silver. One is called registered, one is called eligible. And you want to take note on this too. Registered silver basically means it is something that can be delivered. In other words, if you come with your own truck and your own security guard, you can pick up and you pay a fee, you can pick up the silver and take it out with you. Eligible just means they looked at the silver. It is indeed 0.999 fineness. In other words, 99.9% silver, right? But they're just going to keep it there. It's there for safe storage. So if you want to convert from eligible to registered, you have to fill out a ton of paperwork. You have to get it approved, and only certain people can do it. And then if you want to pick it up, that's all on your expense, right? You have to hire the delivery man. You have to find a truck. You have to get security for that because, probably somebody's going to be looking out at this building and say, oh, somebody's taking very valuable precious metal out of this vault. Right? So you have to take care of all of that. Then you have to truck it all over to wherever your factory is. Then it gets into your warehouse. That's what's called a transaction. That's friction, right? That's called a transaction cost. Okay? So transaction cost basically impede the business, right? It impedes buying and selling. Okay? It freezes the price in place oftentimes. Okay, so what is the price of COMEX silver based off of? Your right to be able to take and pick up the silver. So what people usually do is buy and sell the right to the silver. Paper, they trade paper. They trade certificates. They trade IOUs. All right. Pretty complex, but are you following here so far?
So far.
Good. Because again, it's going to get worse. Now, you would think that for every certification saying this is worth 1,000 ounces, there is indeed exactly 1,000 ounces, right? So if you've got 100 certificates for 1,000 ounces each, there should be at least 100,000 ounces of silver in these vaults at COMEX, right? That's not true either. There's something like a 4 to 5 certifications or sorry, certificates for every ounce of silver. Now, there's always going to be these rationalizations for this kind of thing. Okay. My advice to you is to ignore it because what's a post hoc rationalization, right? You want to do this thing, and then you're coming up with excuses to explain away why we should do it, or why we shouldn't change it, or why it happened. And that's what's happening here. The real purpose of this is to suppress the price of silver that's officially being broadcast, because everybody will, unless you are a factory, okay, unless you're Samsung again, everybody who is wanting to trade silver is going to use the COMEX prices. They're going to refer to that. Okay. Everyday guys, if you want to buy silver or gold at the local coin store, the coin shop, or the pawn shop, what are they going to use as their price? They're going to use COMEX because they don't know what the factories are buying silver from the miners are paying. They don't know that. Okay. So they're going to reference the COMEX prices. Now, here's the thing. If you have money, right? If you have cash and you know inflation is eating away at that. Okay. So this is how inflation plays into this larger picture. Okay. So again, take note of this. How does inflation play into the larger picture here? It plays into the larger picture because you have cash. Now, if there wasn't inflation, or at least there wasn't inflation as insane as it is today, then what do? You can just keep your money in cash, right? It's at least preserved. You don't have to risk it. But if inflation every year is something like 5%, which means after you compound it, in 10 years, you're going to lose more than 50% of the value. What do? You can't just leave it in cash, right? You're going to put it into something that goes up in price. Now that's speculation, right? Because you're not transforming it. Investing is when you transform it. But most of the time, when you buy a stock, you're not buying it for its dividends even. You're speculating that the price will go higher later on when you need to sell it. So one thing is you could sell in the stock market. However, the problem with the stock market is that it can crash. The price of the company that you buy can crash, but also even if you buy an index fund, the whole thing can crash. We've talked about this before, right? Any questions about this here before we move on?
Not at the moment.
Okay. So you can't keep it in cash. You're worried about the stock market. What about bonds and treasuries? Well, they don't really outbeat inflation because the official inflation numbers are much lower than what's really happening, right? Because the prices of these houses are going up much faster. The prices of food is going up much faster. The prices of gasoline is going up much faster. Well, they're categorically excluded from the measurements of inflation. So what are you left with? The stuff you don't really need, like a bigger TV. That's the stuff that doesn't really go up in price. So it's kind of cheating, right? Okay. So inflation makes us think about different places to put our money. Well, what about gold and silver? Because I keep hearing this stuff. Okay, I hear these investors, right? Investors whose personalities I like, but I think they got the picture wrong, you know? They say stuff like, they say, oh, I looked at the amount of gold that I have, and it's the same number, regardless of what COMEX tells me it's worth. Okay, that's cool, but when at times, I mean, are you going to buy your house in gold? Are you going to buy your cars in silver? No. You're going to convert it to cash first. Well, how do you know how much cash you can get out of it, right? It's COMEX. All right. Because if people start to go, okay, I don't want to gamble my money on the stock market, let me just buy silver and gold. That'll go up, right? Even though you're printing out all this cash, right? Because cash is its own supply demand thing. the more cash you print out, right, the less it can buy. Well, they can't just print out gold and silver. They have to dig it up, and that's very difficult, right? So I'll just buy gold and it'll preserve the wealth better, the gold and silver. But if you can push down the price of gold and silver whenever it gets too high, and then on some other times you let it skyrocket, who's going to look at that and say, oh, I feel safe in putting all my money into silver and gold? Are you going to feel safe knowing that earlier this year it was $120 per ounce and now it's $55 per ounce? And in another 6 months, who knows? Do you feel safe or would you?
Not at all.
No, nobody's going to feel safe with that. And I think that's what happened with Bitcoin, by the way. Because Bitcoin, if it grew gradually year after year, like it was supposed to, it's a safe depository of wealth. So instead, what do? You throw in a whole ton of money all of a sudden, you make it spike up, then you throw it and you pull out all your money, and then you make it spike down. But even when it goes up too quickly, people are getting nervous, right? Because it goes up all of a sudden from $100 per Bitcoin to 20,000, and then you buy it at 20,000, and it goes down a little percent, and it goes down to, you know, maybe it goes down 5% to 1,900, right? 1,900. You're out of still a lot of money, right? Even if it goes down 5% in a month, which is not really too bad, you are out a lot of money. So people don't want to buy into Bitcoin, all because you just threw up the price all of a sudden. Okay. And then when it goes down, like this whole year, it goes down 10%, 20%, 30%, people freak out and nobody's going to ever go take Bitcoin seriously as a storage of wealth. Then it becomes a purely speculative instrument. And that's what COMEX prices is. Now, why do I keep talking about silver rather than gold? Because gold doesn't really get consumed up. Okay. Silver gets consumed up. It gets used up into products. You can't really recover it. So the fact that you can use up silver, that's the reason why I invested in the first place, because I knew there was a structural deficit. There was more demand than supply, and it would be really hard to make more supply, okay? Because you can't just build up a mine in a year, right? That's not how it works, okay? And so I thought, okay, this is actually a really safe investment, and that's great. It's going to go up, okay? But I didn't realize that COMEX silver has nothing to do with silver that's being consumed industrially by manufacturers, by factories. Okay. Now, I did have the idea. Now, this is the last piece of the puzzle. I bought into silver miner stocks instead. I said, okay, well, okay, I'm not going to do SLV, SIVR, PSLV, because those track COMEX. So I'm going to buy the stock of these miners directly because they must be making huge profits. And guess what? They did. They made much greater profits than years prior. It went up. They keep beating expectations. They keep beating previous year's profits, looking good. It's very clear by those numbers because they're like, oh yeah, we were able to make a profit per ounce, 20, $30, $40 per ounce. Okay. So that's great. And that makes sense, right? Because silver is in demand, it's getting used up. So I bought silver miners thinking they would go up. But you know what? The market's irrational. It's actually so stupid. This is what happened. When the price of COMEX silver goes down, they don't only sell these guys like SLV, which track COMEX, they actually also simultaneously sell the miners. And it doesn't make any sense, right? Why would you throw away stock in a company that's making more and more money every quarter? Why would you do that? Because COMEX is going down, because they don't understand there's a separation. They don't understand that effectively these are their own two worlds of supply and demand. They don't understand it. So these silver miners are getting sold off. So the silver miners have actually decreased by 50% as well from their highest earlier on. And it was kind of interesting because the big crash happened for COMEX silver in January 30th, but the big crash in silver miners happened almost 2 months after that, or a full month after that, rather, around March 1st when there was the Iranian war starting. Okay. By the way, speaking of which, when I first heard that the Iranian war started, it was on the weekend before the markets opened, and I was feeling kind of guilty because I thought I was going to make a lot of money because, of this event in which lots of innocent people are going to die. And I was feeling guilty about that, even though I shouldn't, right? I'm not buying it. I've already bought it before the Iranian war started, right? And even if the Iranian war started and I bought afterwards, my purchase of these silver mining companies has nothing to do with the existence of the war, right? It's just a accidental benefactor, right? Or a beneficiary of that war starting. Okay. However, Um, what ended up happening is that instead of them going up, it went down. And I didn't find an answer for a long time until somebody said, oh, well, all of these companies are selling off everything because they need to get a lot of cash because with the start of this war, you know, things are, you know, the economy is expected to not do so well overall. So they need to free up a bunch of cash to settle their debts and all this kind of stuff. Okay. Because people are taking their money out of these investments. I mean, that's also really complicated too. So, okay, I was like, okay, fine. Well, at the beginning, there'll be sell-off, but eventually, when the rest of the market when people put their money back into the market, this should go skyrocket, right? No. What I saw was what skyrocketed was these AI companies, and then and then everybody else kind of went neutral, and the silver kept going down. Why? Because it was tracing COMEX, because COMEX kept going down. And COMEX is purely speculative because it's not easy to take out that silver and use it up, right? It's just going to stay there. And it's going to go up because people think it'll be more valuable in the future. And it's going to go down because people think it'll be less valuable in the future. Nobody's really doing their research. So this is a thing that you want to know, right? This is a thing that people just don't talk about. I had to do all this research, months and months of research before finally finding out that this is the case. By the time that happened, all right, the price went way below, like to the low 60s. And by that point, I was like, well, even as a speculative instrument, it makes sense to buy now. But I would have sold a long time ago, back when it was in the 80s, right? If I knew that the market, the investor class was literally this retarded, like they are literally retarded. I'm not using this as a I don't know. People say it's a slur or whatever here, right? But I'm I'm saying in the actual meaning of this word, retarded meaning slow or unable to grow past a certain point, right? Like flame retardant, right? Okay. Investors as a class are literally retarded. Like they're slow to come to the realization. And sometimes they never actually get to realize it at all. Okay. Investors as a whole are literally retarded. That's what I mean here. Okay. You might want to timestamp that one, right? Investors are literally retarded. Um, but anyways, basically, they were selling off the silver miners at the same time they're selling off silver COMEX because they're packaged together. Because they basically thought COMEX really is accurate, but it's not. They're two different, completely different worlds. And silver is an industrial metal. It's not like gold. Okay, it's useful. And there's going to be a growing shortage into the future, no matter how you try to substitute or whatever, because basically, as long as we need more electricity and energy, as long as we need cars, as long as we um, need computers and computer hardware, especially with AI data centers being built everywhere, we need more silver. You can't beat the laws of physics by applying your ideas of finances saying this is substitutable, we could thrift off of this. No, it doesn't work that way. We cannot beat the laws of physics. Okay, demand for products does not mean they get to exist against the laws of physics. All right. So this is why I say the price of silver is going up, but the price of silver is going down because there's actually two prices of silver. There are two prices of silver, and you, as a average guy, are systematically locked out of the price that's actually going up.